Hello everyone, welcome to Risk Management 103, where we continue to build unbreakable habits to thrive in the volatile world of financial markets. Now that you understand the importance of stop losses and position sizing and seen the power of compounding, today I will bust the myth of leverage, show you how to wield it without blowing up your account, sticking to the 1% rule. We will continue to work on the Google Sheet from the last video, showing the game-changing power of a trade diary, and we will look at protecting your wins with a trailing stop loss. Remember, this isn't about getting rich quick, it's about building smart, sustainable strategies that let you sleep at night and keep you in the financial markets game. So grab the trade planner below if you haven't already, and let's dive in. So, leverage. Leverage is like a double-edged sword. It amplifies your gains, but also your losses. So using it correctly is crucial for risk management. Remember rule 1 and 2, never risk more than you can afford to lose and only risk 1% per trade. Well, leverage fits right into this. Leverage is a tool that extends the capability of your capital, not a tool for gambling with more money than you have. Most new investors come into the market with overconfidence after a few lucky wins and think they can get rich quick by increasing their risk tenfold or worse 100 times on the crypto exchanges. Don't be like these guys. Your account will be liquidated in no time. So, how do you use leverage then if not for deegan gambling? Say you have identified a position you want to open that requires a large amount of capital. Maybe your capital is already locked up in another large position, so you don't have enough to enter the new position. What do? Well, you use leverage. Leverage lets you enter the same position size and risk as you normally would, but utilizes much less capital to do so. For example, if you need to enter with $5,000 but you don't have that available, you can use 5 times leverage, thus only using $1,000 from your portfolio instead, while maintaining the exact same risk. Pretty cool, right? Leverage stretches your capital further. Now there is a downside, there is fees from the exchange. You are essentially borrowing money short term from them. You need to watch out for this, as these fees can destroy your profits and then some if you're in an expensive position for a long time. Leverage is often used in the Forex market to make the positions viable for people to enter, as Forex has low volatility, so you need huge sizes to make a decent profit. Let me demonstrate over on the Google Sheets. Now, let's say you've identified a position you want to enter, a really tight position. We'll use our ETH trade as an example again, $2,500 entry, but this time you want a really tight stop loss. $2,450. Remember, our starting capital is $10,000. And with your 1% risk, still at $100, this means you need $5,000 to enter this trade. That's 50% of your portfolio. That's a lot. Maybe you don't have that available. What can we do with leverage? Well, let's check it out. If we use 5 times leverage, you can see now we only need $1,000 to enter the exact same trade. Potential profit's the same, risk reward ratio is the same, stop loss is the same. You can do the same going up to any amount, 10 times. Now you only need $500 to enter the exact same risk profile of this trade, and so on and so forth, stretching your capital, making it work for you. Pretty cool. Now, let's talk about trading diaries. These are your secret weapon for emotional control, testing strategies, and continuous improvement. A trade diary isn't just notes, it's a log of every decision, win or loss, helping spot patterns, refine your strategy, and identify your weaknesses and mistakes. Every legendary trader keeps a diary, and you should too. Markets mess with your head. FOMO, revenge trading, ignoring rules and risk management, poor entries and exits, bad risk reward ratios, you name it. A diary forces accountability. But you have to be honest. You have to be brutally honest with yourself at all times in financial markets, or you won't make it consistently long term. You'll lie to yourself, tricking your mind into believing what you want to happen rather than facing what actually needs to happen. A trade diary cuts through this illusion, revealing what you're truly doing, not just what you think you're doing. But if you start lying in the diary itself, there's absolutely no point in keeping one. Honesty is the key to real growth here. What was your entry rationale? Risk-reward ratio? Did you follow the plan? Stick to the rules or abandon them? Over time, you'll gain an understanding of yourself and your risk tolerance. This is equally important as understanding the financial markets, if not more so. In the spreadsheet, you can add a more in-depth diary if you like, but I prefer to keep notes on the side of each trade of my mistakes or what happened in the markets. And let's take a quick look. Let's say you filled in all your trades here and you've made notes on all of the terrible things you've done along the way, maybe good things, but we'll just use some examples here. Move stop losses so I didn't lose, but then I lost even more anyway, instead of sticking to the plan. Move take profits higher because you wanted more profit, you got greedy, but price turned around and wiped you out instead, causing a loss when you would have won. You closed your position on some bad news at a loss, but the market turned around immediately and went to your take profit anyway. You did not enter a signal because you were afraid of something and you would have won big. You zoomed in on smaller time frames or zoomed out on larger time frames. The chart didn't look quite good on those time frames, so you exited when the trade would have worked out, and so on and so forth. Whatever it is that you've done, these things are good to look over. And over time, and with confidence and experience, you'll see less and less mistakes until you finally nail it. There will always be mistakes, still in moments of weakness, but that's fine as long as you recognise it. Review it weekly, monthly, and yearly to build discipline. This turns losses into lessons and boosts your win rate. Without a diary, you're flying blind, repeating the same mistakes forever on a loop. So, trailing stop losses, another form of protecting capital when there is a sudden change in the markets. This dynamic upgrade to your fixed stop losses moves with price to lock in profits as the position goes your way, protecting gains without cutting winners short. In other words, now you're guaranteed a win if price pulls back. Many exchanges allow you to select a percentage on your positions, automatically updating as the trend continues in your favour. I'm going to show you two simple manual methods, but I encourage you to research some as there are many out there. Firstly, it's important that you give your position enough room to breathe, that is, to be volatile without knocking you out. There's nothing more frustrating than setting a trailing stop loss too close to the winning position, knocking you out, and price continuing without you. The average true range method measures the volatility of the asset over a short-term period, usually 14 days, and creates a band on your trading view chart to set your stop outside of. If the average true range band is penetrated, then something is likely changing with the current trend as the volatility is picked up, so you want to be out of the position. Combine this with taking profits, scale out half at your first target and trail the rest. And let's take a look at silver on the 4 hour. You go into indicators, you can add on your average true range bands. Here's one I added earlier. And I'm just going to run through what this kind of looks like. We're not going into too much detail. Now you identify this range here that's breaking out, and you want to enter a trade on the breakout above here, and you can set your stop loss below the average true range band here. As each candle prints, you can move up your stop loss with the average true range. You get into profit now up here, and you keep your stop loss going, and you can see that this bit would actually be okay because you moved your stop loss back down here on the print. Keep following it round, and eventually you're going to get knocked out when the price comes back against you here. I mean, you can see you're locked in What did you lock in? There. Before getting knocked out, you locked in 2.81 risk reward ratio. So that's one method of doing it. Alternatively, you can use a series of higher highs and higher lows within the current trend and move your stop loss up with that. I'm going to demonstrate with this band, and let's say you play the same breakout trade as before, but you set your stop loss at swing low here instead. You have a higher high made as price breaks out over here, continues up. You have a new higher low here. Now, the higher low isn't confirmed until we get a breakout of this higher high. So, higher high, higher low, higher high here on the breakout, you can move your stop loss up to that higher low. At this point, you've locked in your these gains, but the trade's not over yet. But you can't lose anymore, which is the point. You get a new higher high, a new higher low, a new high high again here. Move your stop loss to the high low. The trend continues. Now you've locked in a 3.13 risk reward ratio return, and this will knock you out. But sometimes this can get silly and just keep going without you. I hope you get the point there on that. Now, I hope you took something away from all of this risk management session and going to protect your capital better moving forward. Risk management is 80% of your success. Bear that in mind. Subscribe for the next risk management video where I'll cover the psychology of winning and losing. Thanks for watching, and leave me a comment. Safe trading.